No, they just say YouTube, Facebook, Twitter, or X, formerly known as Twitter. I guess that's the new name now. Anyway, we're live.
Starlink. I don't know, maybe.
Sorry. Yeah, so we're live. So let's get this show rolling. Hello, Marty. I can't even speak today. I got marbles in my mouth.
What's new?
Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host. I'm once again joined with my good friend Doug Hagerin. Hey, Doug.
Blah, blah, blah. Just kidding. I'm doing well, Kirk. How you doing today?
Doing great. Doing great. Well, let's dive right in. I want to start with a good story because that's the headline of my episode here, which is I went fishing and caught a monster. Well, I'm going to show this picture because it was hilarious. I didn't know what this fish was, but I'm gonna show you all because it's a crazy looking thing. So I went fishing with family friends, and we end up catching this fish. And one of my boys caught it. We actually caught a ton of fish. We caught a bunch of blues. We caught some sea bass. We caught some porgies, and then we caught this thing. I saw this come out, and I was like, "What is this? Did we catch an alien?" I mean, this thing. It doesn't even look like a fish. It's just the weirdest thing I've ever seen. And the guy who's captain of the ship told me. So I would actually ask for those of you listen, put a message in the chat and see if you can figure out what fish this is. At the end, we'll tell you which one it is. But amazing looking fish. Definitely not something to eat, as Doug was saying before the show. Doug, what do you do with this? Do you eat this? Like what?
According to what I can see, yeah, it's perfectly good to eat. I mean, they don't really sell you very well on it. There's like, oh, it's a lot of people like it as bait. Not the most popular fish. Excellent addition of protein to soups and stews. Here's my rule of thumb. If the way they sell this is slamming it into a broth with a lot of other flavors, it's basically saying, yeah, it's not going to kill you, but it's not. You probably don't want to put this, make a steak out of it. So.
Yeah. If you haven't eaten chicken, fish, or meat in the last year and you need some protein, yeah, this will work for you.
That's right. And it looks like the fins. If you need a toothpick at the end, you can clean it out.
Well, the weirdest thing is I was looking at this thing. It looks like it flies. I mean, the wings on this are enormous, and it's crazy stuff. But yeah, it reminds me of the soup and stew thing. There was this children's book called Rock Soup, I think it was. They're like putting rocks in the soup. Oh, it tastes delicious. Like, okay, whatever. So, anyway,
we're getting some responses, Kirk.
Yeah, good. Well, let's. Oh, there we go. Let's see. Yeah. My good friend George, who's a master angler, he picked it. It's a sea robin. So congratulations, George! You win the prize. Your prize is in the mail.
Hey, it did lead me to one question. Does it have blue eggs? That's what I want to know.
I don't know. Thank you, Wikipedia. It'll help out quite a bit. So anyway, I think it's a good start to the show. Thanks, George, for contributing. Wonderful guests, and I'm sure George has caught his fair share of sea robins as well. All right, well, let's just dive right in. Doug, where do you want to start? We got all sorts of data coming out. There's a few topics I want to start before I give it to Doug. I want to start talking about today about China. Huge information coming out China. We could probably have a whole episode on China, given what's going on there. Part of it's just kind of news flash where people are just talking about it. So everyone's talking about it. It's been an issue for years, but all of a sudden now it's a issue because the news is talking about it. So we want to talk a little bit about that because we want to at least help you sift through the BS. Also, we want to talk about inflation, which is, it's not going away. It's not coming back quite yet, but it did come out. We talked about last week with the CPI bumping up from 3 to 3.2. But we do want to talk about all that. So, Doug, where do you want to start the show here with the topics?
You know what? I like what you're talking about with China. Let's start there because not only what I know you're going to go into here, but I think there's some other things in the Chinese news that is really important. Really important to kind of go over in terms of what's kind of going on behind the not the Iron Curtain, but whatever you call their version of it.
The Great Wall, Doug. I think that's
the Great Wall of Curtains. Yes.
All right. Well, let's talk about the main story that people keep talking about over and over, which is So China stopped reporting on the unemployment rate in youth. Now, some people picked this up and some people didn't. I think probably 90% of the media that picked this up had no idea what they're talking about. But let's break this down. So China, like many other countries, and I'll point this out because we talk about in the show, it's not just the information in the news and how they're positioning it, but what's behind the message, right? So you look here. This chart here shows the unemployment rate of 16 to 24-year-olds in China. And as of this last reading, they're no longer reporting on the youth breakout. So it got to a point of 21.3% in June. That was a record high unemployment of youth. If you look back, what was it, about 5 years ago? It was 11.2, and it's been stair-stepping up since then. Of course, there was a lockdown, then everybody got out. The problem is if you look in Europe, some European countries have the same problem. They have really high unemployment rates for youth. I frankly haven't looked what the U.S. is, but this is a problem in China, and they know it's a problem. So their solution is let's just stop reporting it. And this infuriated people in China and everywhere because they're basically just hiding the problem by just not talking about it. Hey, I guess when you got a communist country, you can do whatever you want. But at the end of the day, it doesn't help to hide it because people know it's a problem. The youth know it's a problem. You got 20% of them unemployed. They know it's a problem, right? Just because you didn't report it doesn't mean it's not there. So I'm not surprised that they did that. And we do see things out of China occasionally where they tend to shade the information. The other question that came up, which I thought was interesting, which is China's been manipulating their own economic data for years, for decades. So how high is it? Is it 30? Is it 40? I don't know what the number is. And I think this is one of the challenges with the data coming out of China is a lot of times it's been manipulated and you don't really know what's accurate. Now, I'll point this out in two ways. Now, in the early 2000s and most of the 20s, before we started to disconnect from China, when we were outsourcing all of our manufacturing and a lot of the low wage labor out to China, that allowed us to outsource our inflation. Now, I'm going to take this topic to explain it because it's a little complicated. So I want to make sure everybody understands. So when you have this globalization concept, which we had for decades, right? And the US companies basically realized, hey, Chinese people are smart, they're hardworking, and we can pay them next to nothing, right? And India has the same kind of demographic. And some countries are better at this than others. But we decided as a country, as a corporate community, that China was a great place to outsource our labor. Because instead of paying people $30 an hour, maybe you pay them $30 a day or $30 a week. I don't know what the wages were decades ago, but they were certainly lower. So corporations realized, hey, we can outsource our manufacturing out there, which caused us to take our manufacturing and outsource it to China, which means the U.S. manufacturing was hollowed out. And I think we've all been hearing about this for decades as well. Unions are complaining because, hey, we're not getting jobs. Well, there you go. It's a big part had to do with globalization. Now, what you'll realize is we had a lot of growth in the last 20, 30, 40 years, right? The economy grew quite a bit, but we outsourced a lot of our labor. What that did is that reduced our inflation rate. So let's say we were the only country in the world, which I know a lot of people in this country do believe that there's nothing outside the U.S. borders. But
America,
yeah, America. And I've seen some funny memes to this effect. But anyway, so if you think about like the U.S., right, we're the only country around, and we have growth. Everything's going to grow, right? The prices are going to go up, wages are going to go up. That's just a normal course, right? But if you have no other countries, it all stays in house. So you're going to have inflation, deflation happening based on the growth of the economy. But when you have other countries and you have trade, it makes it more complex because now you're talking about, do you outsource the labor because it's cheaper, or do you outsource, do you sell products internationally? So there's all these moving pieces. But to simplify it, what we did is we outsourced our wage inflation to China. So it allowed us to effectively lower our inflation rate. So what might have been 7 or 8 effectively was 2 or 3 because we outsourced the inflation to China. Now, if you noticed, up until a few years ago, China's inflation, his, within that period of time was traditionally like 7 to 9%. So they had a really high inflation. People attribute to, oh, China's growing. Well, yeah, they're growing because we're sending all our stuff there, and they're producing stuff and sending it back here to buy. And so when we outsourced that inflation to China, they took it, and we lowered our inflation rate to the low inflation rate that we had, which in many ways helped us and helped them. Right? We both benefited. It was a mutually beneficial transaction. They got higher wages. Their people got pulled out of poverty. Well, poverty in this country, if you paid $30 a week, I call that poverty. But in that country, maybe not. I'm not going to distinguish. But they may have gone from $30 a week. Now they're going to $30. Maybe it's like $10 an hour. I don't know what the rate is. But the point is, it's a lot higher. And China's economy has boomed. People are making lots of money. You can attribute some of it to a bubble because there's a lot of it had to do with real estate, and real estate, there's a bit of a bubble there. Getting back to the core element, we're talking about inflation. So when we outsourced that inflation, they had it. And then we started to disconnect, right? Because of the policies we had, which in large part were pushed by Trump, although they started before Trump, but we won't mince words. They started around when Trump was elected, where we started to disconnect from China. And in many ways, that was a good thing, right? There were some things going on that we just allowed to happen because, corporations wanted to make money, and they just kind of just said, we won't worry about some of that human rights stuff. Whatever, we're at least getting cheap goods. But we as a country moved towards disconnecting from China, which in some ways is good, in some ways is bad. In some ways it's good because we're reshoring stuff, or we're regionalizing manufacturing. We're basically spreading our risk around. So if we had a conflict with China, we're not going to be, up the creek. But on the other hand, we also disconnect from China, which makes us more susceptible because when you don't have trade, you tend to have wars. So there's a lot to piecemeal into this, but I don't want to go down rabbit holes. The point being is, as we started to disconnect from China, a lot of the inflation came back to the US. So you saw we had a spike of inflation last year and the year before. We had a huge spike up 7, 8, 9. Now we're down to 3.2, but we had that big spike. And a large part of that had to do with the fact there was a manufacturing supply chain problem. We talked about in the show before, the bullwhip effect and the effects that has. But that supply chain problem is getting fixed. But a large part of that inflation bump was because of that. Now, what you'll notice here is the inflation's come down here in the US, which is good. It's down to the 3s. But China, so think of it this way. China did have an inflation bump up to the 7, 8, 9 for decades. Now it's lower. Now the inflation is disinflationary to the point where we might even have deflation in China. Now, what does that mean? What that means is, if you have an asset bubble, if you have a bubble in their economy and their markets, and you start to have deflation, what could and probably will happen is you will see the economy start to fall. You'll start to see the stock market start to fall, because any sort of bubble at some point gets popped. And China's actually done a reasonable job managing that bubble over the last 20 years, because they've had some times where it was questionable. You could have flipped a coin of which way it was going. So they've done a reasonable job managing that. But they're getting to a point where they're starting to see some deflationary forces which they may not be able to escape. So they're trying to implement some things right now to reverse some of their policies to push inflation back into the system. The problem is, a lot of that inflation came from us, and they're getting a lot less of it. So will they be able to do it? I don't know. I wouldn't take a bet on the positive for their economy, because I think the globalization forces of pushing that inflation are too strong and too powerful for just a simple lowering of interest rates to fix. Now, I could be wrong. China manages their own data. And I also want to point out here that we all rip on China for managing their data, and they certainly do. And I don't think anybody disputes that. You know who else does that? The US. We do that too. So I'm not going to cast stones. We definitely manage our own data. In my mind, there's no question. Now, whether it's 10 basis points or 1 or 3%? I don't know but I can tell it's being managed. I just can't tell what the actual number is. So everyone's kind of doing this to some extent, right? But either way, the data out of China is a little less trustworthy because I think the margins of difference are bigger. So it's a little hard to tell what's true and what isn't. So that being said, there's a lot of information right now coming out about China, about how their economy is starting to slow down, about how they're trying to lower rates and stimulate their economy to get things going again. It's a wait and see. I wouldn't touch China here. I think it's definitely a volatile situation that could go either way. They could figure it out, and if they do, great. But to me, I don't see that as a growth play in the near future. I just think there's just too many question marks, not only with their economy but also with the leadership being, let's say, heavy-handed with their economy. He's trying to manage the economy, and I think we all know, anyone who took economics 101s knows that you can't manage a free market. It's no longer a free market. And when you start to manage a market, you have one person making a decision for everybody. I don't care if that person's Einstein. No single person alive or ever has been alive is smart enough to single-handedly manage an economy. It's just not possible. I mean, look at the Fed. The Fed is the closest thing that we have in the US to managing the economy or managing interest rates or managing inflation. I mean, they do lots of things, but they're the closest thing we have to managing. And they screw it up about once every 5 to 10 years. And we have a crash, and then we have a bubble and a crash. And you could argue whether they're smart or not, but I would argue that they have a lot of smart people working there and they still can't get it right. So how is a single guy out of China, even if he's the smartest guy in China, how is a single man in China going to do all that? He's not. He's going to make mistakes. And he might be able to fix them, but there's still going to be mistakes. And personally, not my bag. I'm not going there. But Doug, what are some thoughts you have about China, inflation? Where do you want to go with this? Because there's a lot to talk about.
Well, yeah, there's lots to talk about. So a couple things I pulled up some data. The U.S. youth unemployment rate, 1991 to 2023, which is 15 to 24-year-olds. In 2022, it was 7.89%, which is actually a 1.81% decline from 2021. At that point in 2021, it was 9.71, down from 14.87 to 2020, COVID, right? But even before that, in 2019, it was 8.37. So we don't have the same youth unemployment rate that China's dealing with. And when you're talking double digits there, and there's something I think that needs to be noted in that is, let's not forget, China had a single child policy for how long? Could you imagine what their youth unemployment rate would be if families were allowed to have 2, 3, 4 kids? I mean, we're talking that right there may be saving them in one capacity with regards to unemployment. Other thing I just saw, China's Evergrande, which is a giant developer of real estate, just filed for bankruptcy protection. So that, obviously that is here in the United States that they filed for protection, because China doesn't have a bankruptcy protection. It's called the government. And so that's good. I mean, I think that's a rippling effect, because obviously, they're starting to see some things there. We'll move into this with some other stuff, maybe, or the de-dollarization is gaining continued traction. But one of the other things I think that is, I think Bloomberg put it really well. They said the security, and it really does reflect what you talked about. The security blanket the Chinese expansion gave the global economy for the past 2 decades is being pulled away. They had a headline that said, China sneezes, but will the world catch a cold, right? So how will this rippling effect? Chinese Communist Party, as you just posted there, had a growth target of 5% for 2023. That's lower than the average 9%. So is it still up? Yeah. But when it's 9+% annual GDP growth, which who knows the accuracy of that, but if that's the case, and now that, has been what the average is, and that's half that, and China is carrying this economy, then, and it falls short of that, that is an incredibly, as you mentioned, bearish signal. The one thing that I think that's also really hurting China, from what I can see and what we've been reading, is we were in COVID, right? And COVID had China had zero COVID lockdowns for a long time, and they were one of the last to really start to loosen up on these restrictions, and we're paying the price for that, because that was really, we talked about the bullwhip effect. Our supply chain got completely derailed. Ports kept shutting down. The factories kept shutting down. Well, all of a sudden, after 3 years of strict COVID lockdowns, China's economy was supposed to recover this year. But look at the pressures that we're dealing with. There is no question, we've talked about this, there is some softening in our economy right now. We're starting to see demand for hiring, the real estate. We're starting to see companies with a harder time servicing their own debt. Well, guess what? China finally came out of these zero COVID lockdowns into an economy that is basically going in inverse direction, right? They expected all of a sudden all that pent up demand that was asking them to supply the supply chain to finally be able to meet all that, right? Well, as we said in one of our last couple of weeks, I can't remember if we talked about it or not, but there was a chart that I saw where right now automobiles, the best, most available automobile is Chrysler. So if you want to get a deal, it's Chrysler. It's about 60 days of inventory in the entire country. That's it. You get into Honda. Honda's down, I believe, right around 30, if not less. So, China, I mean, where do we manufacture a lot of this, right? So China is like, hey, and a lot of that also happens in Mexico and other places, but they open up and say, hey, we're ready to finally start supplying this. But all of a sudden, that pent-up demand is starting to go the other direction. So their timing on finally relieving their zero COVID lockdowns is unfortunately going against some significant headwinds. And of course, property being one of the biggest things that we've been talking about for years, that the property issues in China are going to be a real issue at some point, because when you get into when you start looking behind the wall, right? I mean, they've had how many cities, and this has been one of those things that's been leaked and talked about for a while, especially from people who've emigrated from China, have lived there. These cities are basically empty buildings. It has been one massive facade, and that takes a tremendous amount of capital support, which of course the communist government can do. But as these things they're starting to see some cracks in their ability to continue to keep up that facade, and they are really, and this is the one last thing I want to say about this. Everybody likes, people talk about how China owns us, right? Listen, China is definitely invested heavily in the United States. They definitely have a lot of control on things, but they're also incredibly susceptible to our economy. Like, we own them as much because we don't have that demand. We are the demand country of the world. And if we don't have that demand, China is in significant trouble, because and they're trying to change this. They're trying to create relationships with other parts of the world to replace the demand of the United States, but they rely heavily on our ability to have a strong economy and to keep up that demand side against their supply side. And if that starts to wane, and China's got some real challenges, and that's why they're thinking, this 5% growth rate could woefully underperform even that tempered expectation this year.
Yeah. Well, I think, there's a lot to be said. And actually, I want to point something out because it was interesting, because I'm not an expert in bankruptcy law, but the Evergrande, they filed for Chapter 15, which you hear about, Chapter 7, Chapter 11, whatever, Chapter 13. Chapter 15 is for non-US companies. So just point that out. Just interesting to me. Anyway, so as we kind of wrap up the China part, there's going to be a lot more coming out about China. I mean, Doug talked about the ghost cities that people have been talking about. I actually heard that starting in 2010, where some of the hedge fund managers came out and they're like, "Oh, these are ghost cities." Like, maybe they are, maybe they're not. I read a stat last week that said about a third of household wealth is caught up in real estate in China. That's a lot, and to me, it's also not as much. Where are they putting it? Well, some people are investing in the stock market, but real estate is a big deal in China, and a lot of people own real estate, and there's a lot of people, and there's been a migration from the agricultural sector into cities. And if you go to these major cities, and I have not been there, but I have a friend who lives there, and if you go to these major cities, they're booming. I mean, there's people everywhere. They're buying stuff. The malls are filled. Every once in a while you see something on Twitter like, "Oh, look, the malls are empty." It's like, Yeah, did you get it like when it was closed? Like some of these malls are filled all the time. So I think we get a lot of um, let's just say inaccurate data coming out of China both ways. And this is what I said earlier, right? Like China as a from a governmental level, they are manipulating their data. It is I'm not going to say it's irrefutable, but I don't know anybody who believes it 100%. Like all the investment managers and the economists, they all look at it and say, take that with a grain of salt, right? Because if you think about it, since 1978, the stat that we just put on the screen before, since 1978, China's gotten 9% inflation since then. I would argue that's not how it works. That's like Bernie Madoff saying, "Yeah, I get 9% a year," and yeah, one year I got down to 8, and one year I went up to 10. That's not feasible, right? 9% is not how an economy grows. Economy grows in spikes and valleys. You have booms, you have busts. That is normal. The US has done that. We've seen how we've grown over time, and that's more normal. 9% a year, that's not normal, right? So I'm sure there were years where it might have been 20, there might have been years where it was 2, and maybe the average was 9, because one thing that the Chinese government likes to do is they like to dictate where it should be. And I actually, when I was in college, I majored in economics and I took a bunch of classes about China because at the time it was like the late 90s and it was China's not the country it is now. Like it's come a long way in the last 20 years. But even then, it came a long way in the 20 years before that. So we were talking about the economics, and to me, it was really interesting because they what they do, and I want to kind of point this out so you understand the manipulation of the data. The manipulation of the data is not necessarily, the Politburo, if you will, standing up there and saying this is our number and making it up. That's not what I'm saying. It's actually much worse because what my understanding is what they do is they have these different layers of authority, right? And she stands up and he says, you know what? I want 9% this year. And then he tells his underlings. His underlings say, "All right, I want 9% this year." And they go down the line to like the local town, and the guy who runs the local town's like, "All right, we need 9% this year." Now, if you're running a local town, are you going to be the one to tell she like, "Oh, I screwed that up. I only got 2% this year"? Nope. You're going to find a way, hook or crook, to get that 9%. And whether it happens or not, you're going to tell them, "Yeah, we got 9%. You're good." And they tell them all the way up, "Oh, good. We're growing at 9%. Look, everyone got 9%," right? It's kind of like saying, and I'll bring this framework here to put this in perspective because I heard this somewhere and I thought it was brilliant. And not to take politics out, but this was so well put, I couldn't help but share it. Every single organization we have in our government is corrupt at some level, and many corporations are corrupt at some level. Right? It's just the way our economy is and our culture is. There's just corruption everywhere. But somehow, our last election, 50 different states, 50 different voting rights, 50 different booths, all 100% accurate. So we have corruption everywhere, but somehow the voting system is perfect. It's like, it's the same thing. It's like you have people at the lower end who say, "Hey, this is perfect. There's nothing wrong." So everyone's like, "Yeah, there's nothing wrong." No one's going to admit that they were the failure, right? And so in China, there's a lot of repercussions if you fail. So they just say, "Yep, we hit 9%. Whether it's right or wrong, I don't know." No one knows. That's the problem. So it's not like she's up there saying, "All right, we're going to pick this number." He may be doing that. I have no idea. But I know that starts at a lower level. And this is actually more culture. And there's a good book called, let's see if I can find it. It's called Mr. China. Talks about a guy's exploits in China when he worked there in corporations. And it was really, really interesting book. But anyway, it comes up from a lower level. So you don't know the accuracy. Like in the US, let's just say there's still a little of that, because if you want to see 3% and the big guy, say the big guy says, "Hey, we're hitting 3%," and somehow other people are like, "Well, we're going to hit 3%." I don't know how pervasive that is, but I know that it's not perfectly accurate. And if you want to know what I mean, how about you look at this? If you look at this CPI data or GDP, let's look at GDP data, right? The GDP data is we grew at 3% this year. Let's say that's the number. Well, after they release that number of 3%, next quarter, they release a revision. The revision is, well, actually it was 2%. The next quarter, another revision. Actually, it was 5%. And the next quarter, another revision, well, actually, it was negative 2. Like, if you go back and look at the data releases and all the revisions thereafter, there's a brilliant presentation that Edward Kirshner did when I was at Payne Weber. He was a chief investment strategist, great strategist, terrible stock picker, but great strategist. And he did this presentation where he showed GDP data, CPI data, and all the revisions afterwards. And it was hilarious. Some of these revisions weren't even close. You're talking about like a 5% spread sometimes in the difference. So if you take it out 20 years, it ends up being rubbish. So the first glance data is not going to be accurate. It's going to be the most accurate they could be at that time. And then it gets revised down, revised up, and at some future time, no one's looking at it. So no one cares about the second through the 10th revision. All they care about is the headline release at the time, and that's what moves markets. After that, nobody cares. So this happens everywhere. And this is why I want to point out the perspective, because most people think, well, China's good, China's bad. No, they're just people. They're people trying to solve a problem based on criteria that are laid out for them. The US, it's the same way. We just have a different way of doing it. So there's no such thing as accurate government data. It's just what is the most accurate we can get at the moment. And I'm sure there's a little bit of massaging going on. I've heard some anecdotal stories from people who are kind of more in the thick of it that this does happen, but I'm not going to go down that road because, well, actually, I can go down that road because I have my tinfoil hat right here. So I'm going to wear this a little bit because I was talking a little tinfoil hattish, and the world is not flat, and it's not riding on the back of a turtle either. But that's what people believed about, I don't know, a few hundred years ago. So let's get into one or 2 points. I'm going to hand it back to Doug. So one point I want to bring up is there's a company called GMO, and they are an institutional money manager. And I can't pull up this data, unfortunately, but they have a 7-year asset class forecast. And apparently I can't share this. Oh, well. Anyway, I would highly recommend everybody go check this out. It's just gmo.com. You just go to their 7-year asset class forecast. And what it'll show is it'll show their predictions for a 7-year cycle. So over the next 7 years, they predict that that certain asset classes are going to get a certain type of return. Now, the reason I like this data is because it's a 7-year cycle. It's not a 1 year, it's not a 20 year, it's a 7-year, which is a typical stock market cycle. Now, the last stock market cycle we had was actually quite long. It was a lot longer than normal, but 7 years is on average what the economic cycle is. So if you look here, there are, basically stocks for large cap stocks, they're more or less negative still. If you get into international stocks, you're a little bit positive. You get into emerging markets, emerging market value, you get up to close to 6%. If you're getting into bonds, it's kind of more or less break even. And long-term average for historical equity returns around 6.5. And now most people think, well, it's like 10 or 12%. No, it's 6.5. So the reason I bring this up, and I have to log in, and I don't remember my login, which is why I don't have the chart in front of me, but I'll have to share it in the notes. But go on there and check it out. It's a great thing they put out, every month where they update it. So if the stock market sells off, you might see, oh, it looks like there's more of a positive return. If it spikes like it did in the last few months, it looks like it's negative, in part because the markets are kind of expensive overall. So let's move on to the next.
Hey, Kirk, if you want to give it a share, it's up there now.
Oh, you got it?
Yep, I put it
thanks,
down
Doug.
there at the end of the stream.
Doug is my savior today. All right, so here's the chart. It looks like negative 3% for U.S. large cap, negative 2.4 for U.S. small cap, international large 1.6, 3.6 for international small, emerging 4.4%, emerging value 6%. U.S. bonds 1.1, U.S. bonds hedged. International bonds hedged, basically zero, a little bit negative. Emerging market debt 2.4, U.S. cash 1.8. So how you read this is U.S. cash is, well, 1.8 is not the return. It's the return over 7 years. So they're predicting that rates at some point over the 7 years will go down, which I think is a reasonably accurate measure. So thanks for helping me out, Doug, there. I want to hit on one more point here and then hand it back to Doug. Actually, 2 more points really quick. So the first point is there's a chart of real wages. Now, I want to point this out because real wages are important. They're different from wages. Real wages are inflation adjusted, right? So if we look here, this takes us back for basically to the mid 60s, and someone was nice enough to put the presidents at the bottom for better or worse. But if you look at wages, wages spiked in Nixon, and then they started to decline, and they declined pretty much until mid Clinton era. Then they started to climb back up again. And we're actually relatively close to the peak in 2020. We were really close to the peak that we saw in the early 70s, and then we kind of spiked down a little bit. I bring this up because it's important to understand how real wages affect the economy. And if we have wages that are stagnant and we have prices that are climbing, it means we're getting poorer. So if let's just say the average wage is 50,000, just to make the numbers easy. So the average wage median income is 50,000. I think it's higher, but let's say it's 50. So $50,000, and so for the year you're getting 50,000. You're spending on a certain number of things, right? Spending on gas to power your car. You're spending on rent. You're spending on cable bills, utilities, food, clothes. You have a certain number. Let's say 50 is you're not saving anything. You're spending 50, right? Now your wages are flat. Now let's say we have inflation of 10%, right? So if we have inflation of 10%, that means all of the stuff you're buying is now 10% more expensive, which means if you're making 50,000 and your 50,000 doesn't go up 10%, it stays at 50, that means you're 10% poorer, which means that you're still making 50, but your 50 pays for 45,000 worth of stuff. I'm sorry, in reverse that. You're using 50 to pay 55,000 worth of stuff, which means that you're 5,000 in the hole, which means you have to take that 5,000 that you're no longer making for the same stuff, and you have to say, what can I not spend that on? So it might mean that you can't go out to eat as much. It might mean that you have to sell your house and rent or downside. It means you have to stop paying for DoorDash or all these other things that people are paying for that are luxuries, right? It just means you have 5,000 less to spend in that kind of money. Now, realistically, that's not how it works. Some years inflation goes up, some years wages go up, and overall it kind of balances out. But we've seen a huge spike of inflation, and we did see a little bit of a spike in wages, but most of that came from the COVID era where people were getting free money. And now it's kind of back to where it was. So what I've been seeing and hearing, and from the data and from anecdotal evidence from just talking to people starting to feel the pinch. They're starting to feel poorer, and that means they're going to spend less. Now we had a big phone company. I don't want to name the name, but you know who it is, and they came out with earnings, and the earnings were okay, but they said, things are starting to not look so good. We expect next quarter is not going to look so good. I was in their store a few weeks ago. No one was there. This is in the middle of a mall, a busy mall. No one was there. I was shocked. Usually there's lines out the door. You got a waiting list. No one was there. It was weird. And that was before earnings. So I thought it was kind of accurate after seeing that maybe things are starting to slow down. So it's important to keep track of wages. If wages are going up, that's a good thing. If they're going down, it's a bad thing. If they're in line with the economy, you could argue that then it's not a change, right? Because it's the difference between wages and the economic growth and inflation. So if you have inflation that's the same as real wage growth, and actually I shouldn't say this, if inflation is the same as wage growth, then you're not better or worse. Real wages going up is in excess of inflation, so that's a good thing. So we'll see where that goes, but if we start to have a lot more unemployment because people aren't hiring, because we go into a slowdown, you might start to see a little bit of a tail off there, and we'll see where inflation goes. But I think it's really important to talk about that. So Doug, thoughts from you on this?
Yeah, quite a few thoughts. I think this inflation thing we've talked about a number of different times, and one of the charts you've got talks about one of the bigger inflation impacts over the last 25 years. I want to come back to that, but I think you've got some really good charts there breaking down the consumer price index, where the impact is. And I want to take this from a different angle because, as you know, Kirk, and people who may have listened to me, I haven't been on this pedestal for a while, but I am very concerned about cash flow when it comes to retirement planning or with any kind of planning. And I'm really concerned about, the impact of decisions that people make with regards to what to do with their money. And a lot of times what people have done is they have made decisions based off of the obvious financial impact. And sometimes that has, unfortunately, significantly bigger impact on the other things that they didn't look at. So here's a perfect example. And this comes out of the fact that if you are one of those that is fortunate enough right now to have a mortgage at an interest rate prior to what we've gotten into, okay, then consider yourself hitting the jackpot. If you've got under 2%, under 3%, even under 4% mortgage, you're doing very, very well. And there is still a lot of people who are with that are just absolutely concerned about trying to pay off their mortgage as quickly as possible because they think that being out of debt is actually going to be one of the greatest contributors to financial success. This inflation thing that we're talking about goes two ways, and I've talked about this before. When you take the easy route and you say, "Well, I'm paying on this debt and it has interest," I can see what that cost is, and that cost of interest is something that I want to get rid of. I see what I'm going to pay. The cost of that interest is the part that you feel emotionally that you want to get rid of. But there's also a cost of giving your money away, and that is what your money could have earned. So there's a cost to anything you finance. What we paying interest on somebody else to use somebody else's money, or losing interest on using your own cash, what we call self-financing. I posted something, Kirk, that is kind of a reverse inflation conversation, and why I think this is really important for people to consider, because there are people out there, and I just used a $2,000 mortgage example, which would be a high mortgage, but for a lot of people listening, that might be in the ballpark. And I used an inflation rate of 4%, which is a little bit higher than our historic average. But, we've talked about this. Inflation might be here for a while. Here's the thing. I want you to take a look at your budget right now and ask yourself the one major thing in your budget that is not going up in cost. It's your mortgage. Everything else you have is going to get significantly more expensive. Okay. And I'm talking massively more expensive. We talk about the 3-4% here, but depending on what category we're talking about, medical, college, housing, the way it's been, in the short term, we could be talking 4, 5, 6, 7%, well above regular inflation. Ask yourself, if you get rid of $1 today and spend it on that mortgage, will you potentially be paying down on that interest that they front loaded? You may not be paying as much of, but you also have to ask yourself, are you getting rid of $1 that could grow to try to pay for those things that are more expensive in the future? So if you go back to the thing that I was showing, if you have a $2,000 mortgage today, inflation also works the opposite on fixed expenses. A $2,000 payment today, 20 years from now, is only going to feel like $900 a month at 4% inflation. If we get 30 years from now, it's only going to feel like $600. If we get to 5% of inflation, and I know we don't have that picture up there, then you're talking about that 20-year cost feeling only like $753. I don't know about you, Kirk, but that's kind of what I've been paying in utilities over the last 2 years, right? So ask yourself how quickly you want to throw money at that low interest rate fixed. Even if it's a high interest rate, it's a fixed cost. Nothing else is fixed. This is why it is so important when you're making these financial decisions to ask yourself, once I give away that $1, I lose that $1 forever, and I lose everything I could have earned with it. Do you need that money to be earning? And so just paying off your mortgage that might, in 20 years, feel merely like a utility bill, is that the best decision to be made when everything else that was $700 a day might cost you $3,000 later? Okay. It's something I keep coming back to because people always look at the rising cost, but they don't necessarily look at the impact of using your dollars and how, right now you really have to, if you're going to be facing this higher inflation, it actually benefits your mortgage because it's going to allow that fixed payment to feel even less and less over the years in comparison to everything else. The other thing I wanted to kind of go into is we've talked about, real estate, but that was a great chart that was put up here. If you want to get back to where we were on pre-pandemic housing affordability, which isn't inflation, U.S. incomes would need to spike 69% in order to return to pre-pandemic housing affordability. Not too many people are going to think that's realistic. All right, so how else can we get to affordability? U.S. home prices could fall by 41% to get to pre-pandemic affordability. Or last but not least, mortgage rates could fall to 4.3%. I'm sorry, fall 4.3 percentage points. So go from 7.26 to again under 3, and we return to pre-pandemic affordability. None of these, Kirk, seem like real easy things to accomplish to get us back to pre-pandemic affordability. And that is why we have a housing stall going across the country. By the way, for those out there that say that there is a that the demand's too high and that it's not a supply issue, I would agree. Although I just saw a chart of all the homes have been sitting for 6 months to a year in Dallas. Of all those three things, Kirk, mortgage rates falling, income spiking, or U.S. home prices falling, which one of those do you think is the easiest to shift? Probably home prices. So just something to think about. And for those that are sitting on it, again, just like the markets can be irrational longer than you can be solvent, sitting on a home can potentially be irrational longer than you can remain solvent too. So there's some things to deal with. Now we talk about, I think another thing in there, and I'm all over the place because you've got some great charts, Kirk, but is also the U.S. dollar. The U.S. dollar has really helped, I think, over the last year or so to help kind of overcome some of those prices. It's also correlated, as it often does, to the stock market rising. Now we're starting to see some softening correlating to the U.S. dollar declining. If the U.S. dollar declines, this is not good if we're already feeling the pinch of inflation, because the U.S. dollar declining as a household is going to make it that much more expensive to be able to afford the different things that we need to get from China, which is why, again, it becomes deflationary, because if it's harder for us to purchase, it becomes harder for them to produce and to provide it to us. It pulls back. We're going to feel even more pinch in our household because that's going to make those goods even more expensive. And the last thing I'm going to touch on, because I could go into a lot of different places here, is if we go back to the number one thing that is ultimately contributing to the CPI, you have it in one of the charts, is tuition. As you can see, Pro College Planners, this is my company. It's the thing I talk about. College tuition has been an absolute rising nightmare for families. But there's also some things in here that I think are a little bit misleading. Okay. First of all, yes, you're looking at a 180% increase in the cost of tuition since 2000. And now you can see that a lot of the charts that you see on the bottom, they have kind of slowly start to rise, and then they rise more. You can notice that the college cost rises and then kind of tapers and flattens out a little bit. And I think it's really important. I talked about this last week or the week before. We actually have seen, they've done some data to show when the greatest amount of inflation was in college. And even though this shows over a 7% inflation since 2000, we really have seen a tempering of those costs, especially since 2010, that have helped to slow it down a little bit. And the biggest rise of inflation in college actually was occurring in the 1980s, correlating to Gen X and Gen Y and the astronomical cost of college they see. The other thing that is also a little bit misleading in this is if you look at all of these other costs down there, medical care, yes, your insurance covers a lot of that cost, so that helps. But then look at the rising cost of medical insurance. You're still going to pay a lot, whether it's a $10,000, $12,000, $15,000 deductible before they're going to help medical care, and then all of a sudden you find you have a hospital bill and your anesthesiologist wasn't actually covered in network. Yeah, medical care has been a real problem. It's the number one cause of debt, so much so that when you're applying for mortgages or other types of debt, they kind of ignore medical debt because they look at it like, yeah, everybody's got it, and it is what it is. It does not really an indication of someone who is irresponsible, because you can't really help your health. Food and beverage, though, it's a need. Nothing you can do about it. No discounts, rising costs. Housing, we just talked about the affordability index. Interestingly enough, how apparel has really stayed flat as we've gotten cheaper and cheaper, going from cotton to more like, synthetics and things like that. It's really helped to keep that price down. That's why we have the throwaway retail world that we have. But coming back to college, just the last thing I want to say on this part of it is that why this is so misleading is the colleges understand that they can't just ask for that money and demand that you're going to pay that full bill from an affordability standpoint. The federal government has certainly helped because the federal government took over loans and will lend to everybody. But also understand that the discounts in college have also been going up significantly. And this is really critical because we're coming into the beginning of the college season. A lot of families do not understand that, they look at that cost and think it is what it is. There's a lot of room to negotiate. It's actually a buyer's market if you understand what you're doing. And the average discount in private schools across the country is 56%. That's the average discount. So even though the cost on the surface level has been rising significantly, so has the amount of discounts through merit aid and need-based aid and other things to help get the true cost down to families. I want to bring this up because, again, most people don't have the information or knowledge that they need in order to make a smart buyer's decision when it comes to college. And then at the end of the day, get those discounts that are out there. And many people, unfortunately, they, in the process, they end up going to schools where they're going to pay full price and paying some, again, maybe 2 times more than they should have for the same outcome. So even though that is scaring a lot of people, and it is a huge number here, it doesn't tell all the information in this chart.
Yeah, thanks for that, Doug. And I want to touch on 1 or 2 more things, and we can kind of wrap it up here. Let's see here. So one thing that I wanted to point out, you'd mentioned it quickly, was the US dollar. And I point this out because most people don't follow currencies. Most people live in the US that are listening to this, and there's some international people for sure, but most people live in the US and we use US dollars and we don't use any other currencies. So we don't really understand how it works. If you're in Europe, you know exactly how it works. If you grew up where you had, 20 different currencies, and you had a currency exchange booth on every corner because there were so many people going back and forth between currencies, you needed to have that exchange rate, and people were very sharp about it. But here, none of us really worry about it. I mean, we get a Canadian quarter and we spend it like it's a US quarter, like nobody really cares. But it's important to understand because it does impact the global economy. And so there's what they call the Dixie, or the US dollar index. The US dollar index is actually made up of a bunch of other different currencies. So it's a basket of currencies that are in comparison. It's not just the US dollar, because the way that currencies work is it's one currency versus the next. So it'd be the dollar yen, or the euro yen, or the Canadian dollar, Australian dollar. Like you basically have one versus the other, right? And this is an interesting concept that this will probably swizzle your brain on a Friday if you're not swizzling a drink, is that if you've got 2 different things, right? So you have a dollar in your hand. Here we go. I got 200 million Zim dollars right here. So I got my dollar right here, and I'm going to go buy a loaf of bread. Okay. I'm exchanging this dollar for a loaf of bread, right? So it's a dollar bread ratio, right? Dollar versus bread, right? I'm exchanging one for the other. If I'm buying gold, it's dollar gold. So how many dollars per an ounce of gold do I get? If I'm exchanging this for if I'm exchanging this for a euro, it's dollar euro, right? So dollar on one side, euro on the other. So the exchange rate that the way currencies work is you have a currency pair, one versus the other. And it's just like buying a good. You're buying a currency, you're buying a good or service. It's one versus the other. So that relationship changes every single second of every single day. That changes. And there's small changes, big changes, but you'll notice if you've ever been traveling to Europe or somewhere else, you might notice there's an exchange rate. Sometimes your dollars can go really far. So if the dollar's strong, like if you look here in this chart, you'll see in the late 2020s, the dollar was really strong. And if you look in like late 2022 was really strong. In late 2020, it was really weak. And so if you're traveling to Europe, a great time to travel to Europe is when the dollar is strong because your dollar is strong in comparison to other currencies. What you don't want to do is you don't want to travel when it's weak, when it's more expensive to travel to Europe for the same stuff that you were doing. So I mention that because it has a lot of relationships to global trade. It has relationships to imports and exports. It has to do with travel. It has to do with a lot of different things. And it also has to do with typically when the dollar is strong, it tends to mute the growth of the economy as well, right? Because if you think of it this way, if you're I'll probably be going down a rabbit hole. I'll try to wrap this up because we only got a few minutes. But just understand that when the dollar's strong, it tends to put some pressure on the economy. When the dollar's weak, it tends to lessen that pressure on the economy. So it's not a one-to-one relationship. So if the dollar starts to drop sharply, it doesn't mean that the stock market's going to spike. It could, but it's not always one-to-one. There's a correlation and a little bit of a causation, but it's not a one-to-one by any way, shape, or form. Now, a lot of people think, well, the dollar's going down, that means gold's going up. Not always. If you look at the dollar versus gold, that's actually not happening right now. So there's these interrelationships are only important in a larger sense. If you look at day to day, you're probably going to lose your mind because it doesn't always line up. But if you look at it a longer term perspective, they do tend to line up with where they should be going. So just something to keep in mind. It does have a deflationary effect. So anyway, Doug, you want to wrap it up here, and we'll take it home.
Yeah, that's great. And I wanted to say really quickly that two things. Number one, when we were looking at the wages, and I just wanted to point this out because you mentioned the different presidents. I think it's really important to note it's not political. It's again some Republicans wages went up, some Republicans wages went down, some Democrats wages went up, some Democrats wages went down. Again, we politicized a little bit too much of this stuff and put our hopes a little bit too much. The second thing is you're talking about the dollar and agree. I totally agree. God, not, it's definitely a little bit, but mostly correlated, not causative when you see those things together. But the de-dollarization momentum that's happening as Americans, like you said, we sit here and buy stuff here. But as we're starting to do more global things, or if the dollar doesn't become the international currency, we're going to feel this more. Absolutely, as it relates to the different types of competitive currencies that are out there, which we've had the luxury of never facing. Listen, I'm going to wrap because of the sake of time. If you want to learn more about those discounts for college, you want to learn more about how to actually protect your wealth, your future, and make great decisions about money. Because if you are the type of person that makes smart decisions about money, college being one of those things, debt planning being one of those things, just ultimately, managing your finances and putting it in order and keeping it that way. Learn a little bit more. ProCollegePlanners.com. We have a free checklist you can download. Go there, and if you have any questions, we'd be happy to talk to you.
Awesome. Well, that's it for this week. That's the show again. Thank you for joining us in Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com, and of course, you can find me every week here on the show. Please remember to subscribe to the podcast in the podcast app of your choosing. You can also check out our show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube, so please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment in the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. So please send me an email and express your feelings. If you're seeking financial advice, talk to an oracle, or maybe a fortune teller, or maybe a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.